Hello, everybody. Kirk Spano, Investing 2020s. And we have a lot to talk about today, but we're going to start with the big picture and then work our way through. This will be a public webinar. I'm not going to put this one behind any paywalls. There's a lot of ground to go over. I've been writing these Stocks of the Week articles and retirement income options articles. Been having a lot of life get in the way of work, so I do apologize for that. Summer extended a little longer. And then a few weeks ago, I wasn't feeling so well. So I decided to start to get healthy and been walking every day and dieting and exercise the right way. Doctor seems to think I'm headed back in the right direction. I tell you what, it is easy to sit in a chair. And sitting in a chair is just freaking bad for you. It really is. So we got the Fitbit going again, walking around 2 to 3 miles every single day and just getting out of this dumb chair at least every 2 hours, but trying to do it every hour. Drinking glasses of water every time I walk downstairs. Drink a glass, pour the next one, let it get to room temperature by the time I get down there. Down 5 pounds in 2 weeks, which is my goal. My goal is to lose 10 pounds a month until May on average. So hopefully we have a couple of big months here. I have to meet with a trainer, go through a couple of new exercises on the machine so I don't break a machine because I break things. And yeah, go from there. I will tell you, I am so pumped up about the next year. I'm going to tell you some things that are going to happen. First off, higher for longer isn't really going to be for that long. Oh, right. I've been telling you for 2 years now that this is the Fed reloading its bazooka. Well, the bazooka is almost reloaded. And why were they reloading it? Because there's this big wall of debt maturities coming next year. We've talked about this before. Let's talk about it again. As the debts come due, the Federal Reserve and the Treasury have to recirculate and repopulate and recombobulate the Treasury market so that it remains the single largest financial market in the world. They're going to have to either pull back on quantitative tightening or add money and at the same time take money, which is what I think they're going to do, actually, at least for a while. If we have a crisis, all bets are off, but I don't think we're at crisis levels just yet. I don't think that comes for 6, 7, 8 years after all the private equity loans go bust. But we talked about that the other day. Let's talk about what next year looks like. First of all, I'm going to win a World Series of Poker bracelet. I'm just telling you, I can feel it. My game is there. I played a little bit last night, took third place. I'm also going to see lots of you make a lot of money on a Metis. I will get to that in just a couple of minutes. This big macro picture, though, of the Fed and the Treasury supply and Europe being just stuck. I have no idea what's going to fix Europe. I told you this before. I just think Europe meddles along sideways for years and years and years. And if not a whole nother generation, I think they're going to have another lost decade or two. There's just very little reason to invest in developed Europe. Eastern Europe, so there's some good opportunities. And I tell you what, as soon as Russia is completely out of Ukraine, I am going to invest in Ukraine because Ukraine is going to come screaming back with a flood of rebuilding, with all sorts of people putting their money there. And when I say all sorts of people, I mean businesses, I mean governments, I mean NGOs, I mean the World Bank, I mean, just everybody. People are going to go there to the places that aren't bombed to hell, and even some of the places that are bombed to hell. And you're going to see volunteers. Ukraine is going to be rebuilt fast and effectively and just with hundreds of billions of dollars. So keep an eye on that because the knock-on effects for the other countries on the border with Russia is going to be pretty strong. You're going to see a new security apparatus that basically encourages Russia to grow up, I guess would be the word I would use, because they have acted like stupid little children who are living under the dictatorial father that really just needs to zucking die. But that overall by itself isn't going to be enough to move the needle for the Fed, right? Because the Treasury market is so deep and so strong and so misunderstood that when these things happen, which we've seen it happen a couple of times, I mean, every Every time I tell you about the treasury market and about the strength of the dollar, it comes true. Why? It's because my theory of all of this is right. The doom and gloomers have been wrong, 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 and they will continue to be wrong, 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 because debt is not the issue. Use the word relative strength of the economy, relative productive capacity, relative stability, relative financial reach, and then relative debt. We're just so much richer and better positioned than any other large country in the world that it's just it's not like the difference between two all-star baseball players who one's a little older, one's a little younger. That's not what it's like. It's like the difference between Henry Aaron and a guy struggling to be the fourth outfielder on a baseball team. It's the difference between Stan Musial and the guy who got a cup of coffee in the major leagues. That's the difference between the United States and who's second. That's the difference between the United States and China. Well, yeah, but our economies are about the same size. They have 1.4 billion people or whatever it is. Our per capita GDP isn't 10 or 20% higher. It's 4 zucking times higher. Just think that through. Ted Williams was giving some rookie baseball player batting tips, and the rookie baseball player told him, hey, you know what? I'm just going to go with what got me here. Ted Williams looked at him and was like, all right, guess which guy wasn't on the team the next year? Now, you could say Ted Williams to be smart because he had to go to World War II and the Korean War, but he was actually on the team the next year. That rookie was gone. He didn't improve. He was a guy that got there, probably on the back of being a little bit better athlete. The high school all-star shortstop who decided his shazat did not stink. By the time he got to the next level, where everybody is good, his bad attitude betrayed him. And the bad attitude that people have about the United States, about debt, and about the Treasury, and about the Fed, about the dollar, blah, 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 blah. They keep losing bets, betting against America, and they keep losing bets by being negative. It's hard to be a short seller. Got to get the timing right. And sure, you can make a trade here and there because things go your way for a hot minute. But the best trade has always been to be long America, and in particular, long small cap companies in America that have growth. Right? There's a lot of small cap companies that don't have growth, a dream and a financing scheme. But small companies that have growth have been and always will be the greatest investments in the world. Most of them come out of America. But if you've watched the emerging markets over the last 20, 30 years, you've noticed that small cap emerging markets funds have generally done better than emerging markets developed in large cap funds than emerging market large cap funds. It's the nature of things. Small companies become big companies. The problem is so many small companies get started to try to make money on the hype cycle and dreams of investors of striking it rich and getting in early with the knowledge that most people never do the research, that they don't really understand business, that they invest in really bad business models. So when you think about businesses, remember, you got to think about what is the competitive advantage? What is the durable competitive advantage? Comparative advantage, call either one. And is there a way for them to continue to have lots and lots of recurring revenue at high margins? Are they selling a thing that everybody wants? Are they selling a subscription? Are they selling something that you need more of the next day? And in an environment where interest rates are high and the Fed is trying to convince people that interest rates will be higher for longer, the market gets jittery. And that great divergence that I've been talking about happens. And it's been slow to come because people don't want to believe it, because it's a complex idea. Because large companies that pay dividends and have debt have been able to do it for an extended period of time because interest rates did nothing but come down. And we're close to zero. So now that we are basically smack dab in the late innings of the great normalization, because that's what it is, interest rates are not high. They are normal, historically speaking. All this has been is the great normalization. And that's what you should call it. Why? Because I want credit for it. That's why. The great normalization is in the late innings. We know the most countries on the planet can't afford their debt because most countries on the planet are debtor nations. There's only a few creditor nations. And honest goodness truth is that it doesn't matter because these aren't the kind of creditors that can take possession of assets, right? If you owe money on a house and you don't pay the mortgage, they'll take the house. China ain't gonna ever come and just take America. Saudi Arabia ain't. And China only has enough credit to support their own economy because the federal credit that they have is offset by the incredible, horrible credit positions of the provinces, like in the United States. Let's suppose that the United States was running a federal budget surplus and had a lot of extra money on the balance sheet, but every state in the country was bankrupt, right? They'd have to bail them out. Couldn't go and repossess somebody else's, stuff. So at this moment, when you see big strikes going on, and before that you were seeing quiet quitting, people refusing to go back to the office, right? That's power moving towards labor. And unfortunately, that moves like a pendulum too. We've had a hard time finding balance. One of the things that the Fed can impact is labor. And by being tighter for longer, they could break labor. I don't think they're going to do it because I think the American central bankers are smarter than the European central bankers. Maybe not as smart as the Japanese central bankers, who have very successfully fought off aging demographics. And because they're a contained, homogenous system, maybe they had an advantage in doing it. The United States' advantage is that we're huger and stronger. So all these ideas put together, you need to try to see the trees as well as the forest. Understand the forest is gigantic, that each tree has value. So when we look at this treasury chart, when we take a look at TLT, how long ago did I draw this line in the low 80s, that bottom fishing thing right here? I mean, you can pull this chart up from quite a while ago. It said basically the same things. I've moved the boxes around, changed colors a little bit. TLT is bottoming right now. May have a few more dollars to go. But by next year, when the debts start coming due and have to be recycled, and that's all they are, they don't get paid off. Don't think of it that way. They just get recycled. Stretch them out further. Do you know why? Because in the long run, we're all dead. Who said that? Who said in the long run, we're all dead? Come on, somebody. Einstein, no. Keynes, that's right. Teresa, you have to have a 30-second delay from here on out, okay, Teresa? You can't answer questions until you count to 30. But that is the right answer. Not the general theory of relativity, right? But the general theory of employment, interest, and money. Folks, this is the most important book ever written about economics and investing. Keynes was a wildly successful investor because he understood the big picture and he understood the moving parts. If you want a dense, hard to read book, this is the one to put some time into because you will understand the world in a way that you've never understood it before. If you can work your way through this book a couple times in a year or two, because that's what it'll take. I've read it 3 times. You will understand the world in a way that offers a clarity, a way to visualize how the world works, why it does what it does, and the idea that running a balanced budget isn't all that important as long as you do it sometimes. You don't have to do it all the time. And given that we are in a multi-generational transition from hyper-growth in young populations to slow growth forever and an older population that will soon be mining asteroids, it's different. It just is different. Who's watching Foundation right now? Anybody watching Foundation? Isaac Asimov, it's on Apple. Of course, Teresa is. Psychohistory. Think about the way things move, right? Elliott Wave is actually a little bit based on psychohistory, I would say. I don't know if you thought of it that way. It's the way of predicting the movements of crowds, of sentiment, and the things that sentiment impacts. What we're seeing in this chart here is the psychohistory of what's been developing in America for a long time. The aging of the baby boomers, the shift to a more stable economy of rapid technological growth, older populations, frankly, easier living. But again, it'll take generations for this all to play out. We are 4 generations in, we probably have 2 to 4 to go. 8 generations would be the normal cycle, actually. 4 and 4. If you ever read The Fourth Turning, you'll understand what I just talked about. If you haven't read The Fourth Turning, you should read it. A lot of great insight. So what is TLT going to do for you? It's going to bottom here soon, around 80 something. Maybe it sniffs the 70s. This area right here is massive support. Massive support we're coming into. Resistance, broke it, held it, never seen it again. So we're going to chop along here for a hot minute. Then you're going to see interest rates come down rather dramatically next year. It'll be fast. It'll be hard. They have to try to do it in a way that doesn't scare the shit out of people. Because one of the things about debt in the short term is you have to finance it. So to keep the U.S. Treasury market the deepest and safest market in the world, we're going to demonstrate again the power of the U.S. economy, the overwhelming power of the U.S. economy as we patch little problems. Wages are going up. Strikes are being settled, right? Screenwriters Guild settled this weekend. Ford and the UAW have made a lot of progress. I bet their strike is over in the next week or two. GM and Stellantis are playing hardball. They don't really understand that's not a game that they can win. If they bust the union or try to bust the union, their sales will fall through the floor. So while I respect Mary Barra in general, fact is she's also skimming the system at $30 million a year, right? About 40% more than Farley over at Ford. Everybody at Stellantis are crooks. They're finance people running a car company. Once again, Farley is standing out by working things out, by getting ahead of it. That's why I still think that Ford is going to catch Tesla in EV sales by about 2026 or 27. It's going to be fast. TLT, big debt wall coming next year. Regional banks that refuse to merge. Just said that to somebody on the telephone because they called at about 11:30. Retail banks are refusing to merge. What did we talk about in the spring? That they had to merge. Fed, FDIC suggested that they merge. A couple of regional banks bought some of the banks that went under. What was the dynamic there again? It was the FDIC and the Fed working together to protect who? The depositors. And letting the bank stocks go to zero, letting the executives get fired without compensation, being subject to clawbacks, and the bondholders taking roughly 90% haircuts in many cases. So sometime next year, this is the situation that you're going to see. One of the banks that said, well, we don't need to merge because we weren't doing high risk loans and we weren't over leveraging and we weren't in crypto, is going to get in trouble. One of these holier than thou regional banks is going to have a problem because their commercial real estate loans start to stick it to them. And I don't know which one will go down first, but it's coming because the process of working out commercial debt is going to take years. It doesn't happen overnight because the buyers of these buildings that need to be redeveloped take a lot of money. So the bank that lent $1 billion to build a building that they thought was worth $1.5 billion, it's only worth $500 million and is going to take hundreds of millions to redevelop probably, are going to take massive haircuts, 50, 60, 70, 80, 90% sometimes. I've got a friend who has been very successful in bars and restaurants in Milwaukee. Known him since the late 80s. I went to high school with his sister. And in 2006 and 7, I remember sitting with him at one of his bars. He said, man, I have never seen business this good. It can't possibly last. I go, and I've been a Harry Dent guy for a long time. I said, have you noticed that the people in the bars are getting older? He goes, yeah. Fewer 20-year-olds dancing on the bar. More 30-year-olds passing out on the bar. Yeah. So he sold 2 of his bars in 2007 because, they had a dream. Financial crisis came, wiped them all out, wiped both of them out. 2010, 11, 12, the bank comes to him and says, you're not interested in getting back in this business, are you? He said, nah, not me. I'm good only having 2 bars. I don't want 2 more. He let him stew on it because there was no buyers in 2010, 11, 12. 2012, he goes to the bank, goes, you haven't found anybody to buy my old bars? No. Well, I'm pretty refreshed. Let me think about it. Months go by. Banker calls. Hey, have you thought about this? I'll tell you what I can do. Let's take a look, see what kind of work has to be done. Goes into these bars. He goes, well, it's going to take a lot of money to reopen these. And the bank says, well, we'll sell it to you cheap. And he goes, nah, this is how much it's going to take to really reopen these and make them successful. I'll tell you the deal I'll do. You give me these bars, and I will borrow the money from you to rehab them and get restarted. The bank's, well, we got to get something for the bar. And he goes, I'll tell you what. I'll give you the value of the land underneath it, but that's it. He got that at a haircut, too. I tell you that story because he ended up getting the bars back. He got money to rehab them, skimmed his own little fee out of there. Now these bars are super successful because they're brand new. It costs a lot of money. Who took it on the chin there? It was the bank, right? It was the bank. They got just waxed. That's what's going to happen next year. except it's going to be commercial properties. Talked about some of those properties a few months ago, back when I went to San Francisco. The banks are going to take 50, 60, 70%, sometimes 90% haircuts on some of these commercial properties because redevelopment costs are high. And the only real value is the value of the land underneath them. So when that banking crisis comes sometime next year, I'm guessing second quarter maybe, the Fed and the FDIC are going to play hardball. Ultimately, they get involved, but they have to let one of the banks go down in a Lehman moment. They're going to. The only people with any protections are the depositors. The shareholders are going to get creamed. The bondholders are going to get creamed. The executives are going to get sacked. Their only potential salvation is mergers and acquisitions become bigger. Fewer banks that are bigger. We're the most overbanked country in the world. That consolidation has to come. We're not in that ETF right now because it rallied on hopium, but without real change. So it usually is the case that people have to be scared to hell to change. So there's going to be a big scary moment next year. All sorts of debt maturities at the sovereign level and commercial real estate. And yes, the Fed's going to lower interest rates. Probably there will be a 1% cut at some point, I would think. It'll probably come on the back of a bank failure. Hey, we're doing this to ensure stability in the banking system. It's not unseeable. Now, will the Fed do something like that out of the ordinary, kind of big move without a crisis of some sort? No, I don't think so. So if I'm wrong and the banks don't run into trouble next year, then you'll just see incremental reductions, quarter point, maybe half point, quarter point, something like that. But if there's a bank problem next year, which I think is 90% likely, I mean, it's that high. And you have the sovereign debt coming due. You have to reinforce the treasury market. And the best way to do that is to get rid of quantitative tightening or offset it somehow. You see these two moving parts that seem like they're apart, but really they're together. Because who owns a whole bunch of treasuries? The banks, right? The banks own a whole bunch of treasuries. So if the Fed is doing quantitative tightening on that side of the economy, but is pumping money into the banks, basically quantitative easing, you have quantitative tightening and quantitative easing going on at the same time. And all it is a repositioning of the money. And by getting more money in the banks, who are hugely active in the treasury market, you create a deeper treasury market. Banks are fractional, right? Fractional banking. They'll take $10 and turn it into $20 because they give you leverage on your money. You want to buy a house? Put 20% down, we'll give you the rest. 5 times, right? You ever wondered why most banks are leveraged at about 6-1, right? Think about the mortgages. It's their biggest loan other than the business loans. That's why it's 6-1. When you see a bank at 10-1 or 15-1 or 20-1, that's when you should go, they're not taking much collateral. If they're not taking much collateral, what does that mean? It's more risky, right? Ask Lehman. And if next year commercial real estate takes the last leg down in their pricing, collateral has shrunk. Work in either direction. Expect this moment first half of next year. I'd be shocked if it takes longer. And from that point on, financial conditions will get looser. Now, can they get looser before then? I think a little bit, because markets anticipate this stuff. They sniff it out. I'm usually a year or two ahead. I've been talking about this for 2 years, about the whole great normalization cycle. TLT is going to come down to the lower 80s, maybe a little lower, not much. And then as they offset the QT, probably with QE on the other side, on the banking side, right? QT everywhere else, but QE in banking, adds to the depth of the treasury market. The banks lend the money out, growth takes off. Stock market surges. Stock market probably leads growth. It's a normal way of things, right? Hype cycle. So I've been telling you, through the end of the year, you want to be a buyer. You have to keep an eye on the congressional stuff because the best time to buy will be when it looks the worst in Washington, D.C. TLT way back 2008. Look over here. Look at that spike, right? Went from the 50s to the 80s pretty quick. I would anticipate about a 50% rise off the bottom. And if it comes from here, look at that resistance right there. I need a drawing tool. Right about there. Resistance. I'm going to make that one green. Let's make that one green. Let's put in one of these little doohickeys. There you go. From about here to about here. Right, that'll be resistance again. Look how it was support there too. Then it jitterbugged, and then it broke through. So we probably get it back up to here, and then jitterbug for a long time. Ultimately, The Fed funds rate should be in the threes, closer to 3 than 4. Eventually, probably on a recession, gets down to close to 1 or 2 again. But I'm not sure when we're going to have a recession, because unless we decide to have stagflation, and it doesn't look like we're going to. You all see what happened in the last week? 500,000 work visas, right? People who qualified for asylum, mainly Venezuelans. And immigration that I talked about is starting. They're doing it in ways that they can justify. Here, you're from Venezuela, you get asylum, blanket. Here's 500,000 work visas, good for 18 months. So suddenly, you have a lot of people willing to work for $15 an hour, don't you? You know how much they were making per day? Some of the jobs that they had in Colombia, which is where a lot of them came from, yeah, between $5 and $15 a day, not an hour, a day. Think about how these big things move. Get off your ideology and your politics. If your ideology and politics aren't that the United States is the global leader in virtually every way, that we are more insulated than almost anybody in the world, that really we control the levers, we are Henry Aaron against fourth outfielders, you're not thinking about it the right way, period. End of story. You're wrong. Once you accept that a negative view is wrong, start looking at, okay, how's this going to go? And I will tell you, the reason you're going to want to own TLT instead of cash in your accounts is because interest rates are destined to come down next year. The value of the bonds will go up. It's that simple. And treasuries, the reason that are considered the risk-free investment is because ultimately they can be turned into cash. TLT, I wasn't sure if it was going to come down to this level, but apparently it's going to hit my target. It's going to hit my bottom fishing, give or take. It's going to coincide with the calendar of the banks facing their merger minute. And the Fed's going to probably let the hammer come down on somebody. We'll see. Maybe the Fed is saying behind closed doors with these bankers, look, get the mergers done now, do it, or we're going to let somebody burn. Do the bankers take a chance that they're the one to burn? Right? How much pressure can the Fed, the FDIC, but the Fed mainly, put on the strong regional banks to start getting into these mergers? How much support are they going to have to provide? One way or another, it'll happen. We just have to see how. But the time frame is pretty imminent. All right, I'm going to talk about Ametis off air. So I will catch you again in just a moment.